Getting into interpreting 42 macro research, we'll start, as always, with our friends in the retail investor space. So we built our KISS portfolio construction process to help you guys manage risks, to make money in financial markets and protect gains in financial markets when it's time to do that. So in terms of the factor selection there, we developed a 60-30-10 trend following strategy that is likely to materially outperform the standard 60-40 portfolio over the long term. The 42 macro KISS portfolio construction process is a thoughtful evolution of the 60-40 portfolio framework. Our 60-30-10 trend following strategy is designed to simplify investing, minimize downside capture during bear markets, and maximize upside capture during bull markets. In terms of how the factor selection works, so it's 60% spot equities, 30% fixed income, and 10% Bitcoin. So in terms of the equities, our default equity exposure is 60%, is a SPY ETF. Investors may allocate that 60% to an alternate equity ETF or basket of equity ETFs that is better aligned with their individual investment preferences, risk tolerance, and or product availability. Consult our discretionary risk management overlay for ideas there. In terms of the fixed income, our default exposure is the core U.S. aggregate. That's the Ag ETF. Investors may allocate that 30% to an alternate fixed income ETF or a basket of fixed income ETFs that is better aligned with their individual investment preferences, risk tolerance, and or product availability. Consult our discretionary risk management overlay for ideas there as well. And then lastly, Bitcoin. So our default exposure is Bitcoin FBTC. Investors may allocate that 10% to the Bitcoin token directly, or to gold, or to a basket of physical commodities, or a basket of cryptocurrencies that is better aligned with their individual investment preferences, risk tolerance, and or product availability. Consult our discretionary risk management overlay for ideas. So the real meat of the KISS portfolio construction process are the systematic top-down and bottom-up risk management overlays. So in terms of the top-down risk management overlay, we use our global macro risk matrix to incorporate volatility targeting into our 60-30-10 trend following strategy. In terms of equities, if the market regime is in a risk-on condition, i.e. Goldilocks or reflation, then the target allocation for the SPY ETF is 60%. If the market regime is in a risk-off condition, i.e. inflation or deflation, then the target allocation for the SPY ETF gets cut in half to 30%. And in terms of fixed income, if the market regime is in a disinflationary condition, i.e. Goldilocks or deflation, then the target allocation for the Ag ETF is 30%. And if the market regime is in an inflationary condition, i.e. reflation or inflation, then the target allocation for the Ag ETF gets cut in half to 15%. And then lastly, with respect to Bitcoin, if the market regime is in a risk-on condition, then the target allocation for the FBTC ETF is 10%. And then if the market regime is in a risk-off condition, then the target allocation for the Bitcoin ETF FBTC gets cut in half to 5%. And then lastly, with respect to our bottom-up risk management overlay, we use our volatility adjusted momentum signal to incorporate dynamic position sizing into our 60-30-10 trend following strategy. So if any of these ETFs is bullish VAMs, then the actual exposure, what you will feel in your portfolio, is 100% of whatever the recommended target allocation is according to the market regime. If the ETF is neutral VAMs, then the actual exposure gets cut in half to the 50% of the target allocation. And then if one of these ETFs goes to bearish from the perspective of our volatility adjusted momentum signal, then we cut the position altogether. And then this is both of these overlays are designed to help you maximize upside capture in bull markets and minimize downside capture during bear markets. And so this is the back test for our KISS portfolio construction process. So on the chart on the left, we just show the hypothetical performance of a $100,000 portfolio since the end of 2017. As you can see, KISS has a Sharpe ratio of about 0.8. This compares very favorably to a Sharpe ratio of 0.5 for the 60-40 portfolio. And then on the chart on the right here, we show the hypothetical performance of KISS, the KISS portfolio over industry standard reporting horizons. So the key takeaway from here is that KISS has an average annual return of about 13%, which compares very favorably to 60-40's average annual return of 8% over the life of this out-of-sample back test, which again begins at the beginning of 2018. That's obviously outperforming the thing we want it to outperform, which is the 60-40 portfolio. And then we also layered on a back test that shows the what you would experience as an investor if you were just long 60-30-10 SPY, Ag, and Bitcoin raw without the top-down and bottom-up risk management overlays on the previous slide. So if you execute 60-30-10 portfolio construction without those overlays, then you'll have an average annual return of about 14%. But the max drawdown for that particular strategy is minus 26%, which compares terribly compared to the max drawdown of minus 12% for the KISS strategy, which does feature the top-down and bottom-up risk management overlays. So just be aware of that. There's only one double-digit drawdown in the KISS portfolio construction process. Again, that's at minus 12% max drawdown. There's two crashes in the 60-40 portfolio since the beginning of 2018. here at minus 22% in terms of max drawdown there. And there have been 3 crashes in that 60-30-10 raw approach since the beginning of 2018. So there's a tremendous amount of value in adding something like Bitcoin or adding alternate investment vehicles into your investment strategy in order to outperform the 60-40 portfolio over the long term, which we believe may be quite compromised for a variety of reasons. Consult our macro scouting report presentations for that longer term research. And then obviously KISS does its job. Not only does its job in terms of helping you make money, but it helps you protect gains in financial markets, which I think is just as important, particularly when you're in these raging bull markets. And we have a tremendous amount of experience in helping people get out at or near the highs, and we fully expect to help you do that here as well. So getting into our current KISS portfolio construction, no changes week over week here or day over day. And so very few changes, generally speaking. The turnover, this out of sample back test have been on average 35 trades per year, which turns to about 3 trades per month. That's what you should expect, generally speaking, in terms of executing this process. So it's pretty simple. It's systematic. It's simple, and again, it's designed for our retail investor friends and our RA investor friends to best take advantage of 42 macro research in terms of keeping them on the right side of market risk. So in terms of where we are currently, we're at 60% in terms of SPY, 15% in terms of ag, 10% in Bitcoin, and then that other 15% that would otherwise be in ag is in USFR. That's our preferred liquidity management instrument. It's yielding about 5.2% right now, so that's a good thing. So we'll keep it moving there. So in terms of USFR, so that's our liquidity management instrument there. In terms of equities, the actual exposure is 100% of the target allocation of 60% because the SPY is bullish, and the market regime is Goldilocks, and that's a risk-on regime. In terms of the ag, the actual exposure equals half of the target allocation of 30%. We are in a disinflationary market regime, i.e. Goldilocks, so the target allocation is 30%, but we're only getting half of that in terms of the actual exposure because the ag ETF is neutral. And then lastly, Bitcoin, the actual exposure is 100% of the target allocation of 10%. And so again, we're in a risk-on market regime, i.e. Goldilocks, and the Bitcoin is bullish, and so the actual exposure is 100% of that target allocation. So we're not fully invested, but pretty close to being fully invested here. And then we expect, again, we don't predict the predictors here, but just generally our general market thoughts is that we believe the risk-on market regime is likely to survive at least for another few months, could potentially survive for another couple of quarters. But our expectation is sometime within the next 1 to 2 quarters, we'll have a transition to a risk-off market regime, because it'll become very obvious by then that sticky inflation, which is currently a developing theme, is something that can actually become a real dominant theme amongst market consensus. And we're not there yet, but we do believe that's something that we will be dealing with in the second half of the year.